Let's consider an example to help you with your queries. Let's think about a business, ABC, which makes a sale to a customer called Mr. Shady, and the value of that sale is going to be $1,000. For whatever reason, the business decides that they want to set up an allowance for this customer because they believe that he may not be able to pay. Now, in creating the initial allowance, they would debit the irrecoverable debt expense, which I'll abbreviate as IDE, for 1,000, and they would credit an allowance for receivables account, which is a separate ledger to the receivables for the same amount. Now, let's take this a step further and assume that at the end of the year, this was the only balance within the allowance for receivables ledger. So at the first year end, the carrying value of the allowance ledger is simply going to be 1,000. Now, bear in mind that the allowance for receivables is an estimate, and in subsequent years it may change, and that is absolutely fine because in accordance with accounting rules, changes in estimates are dealt with prospectively. And what that means is you don't need to go back and change anything that happened in the previous year. So let's extend the story for Mr. Shady so that in the following year, so let's say we are now into the next year, and Mr. Shady actually happens to pay up $200. Now, bear in mind that initially when we set up the allowance for Mr. Shady, we didn't reduce his receivables balance. We actually set up a separate ledger called Allowances. So when Mr. Shady pays up, we're going to post the same double entry that we would normally post when any receivable pays us money, and that is to debit cash $200, and you would credit the receivable $200. And in doing so, you are reducing Mr. Shady's balance down to $800. Now, at this point, we want to be thinking about the allowance. Now, allowances are always adjusted for at the end of the year. In other words, the accountant at the end of the year will think of an estimate that's reasonable for that allowance. Now, our example is fairly simplistic in that it only contains Mr. Shady's balance within the allowance. Therefore, if we think about what's happened this year, well, we know Mr. Shady has paid some money, but there is still some that he hasn't paid. And ABC Limited are perhaps still, as a business, worried that they might not receive the rest. So if that's the case, what might happen is that the accountant might decide that the year-end balance of the allowance needs to be reduced. Okay, and remember, this is the process that would typically work. They would determine the estimate of the allowance for the end of the current year. And we know that that allowance should be $800. But we also know that at the start of the year, the balance brought forward or brought down was 1,000. And we're now saying that the balance carried forward, i.e. the balance at the end of the year, is 800. What we notice is that that is a decrease of $200. So how would we go about posting this? Well, in essence, what you would do is think about the reduction to the allowance for receivables ledger. And to post a reduction to the allowance ledger, you would simply debit the allowance by the difference that we've identified, 200, and you would post a corresponding credit to the irrecoverable debt expense account. Now, if you're wondering why we're doing this, well, think about this as a reversal to the original irrecoverable debt expense that we had debited. So if we go back to the initial posting when we thought Mr. Shady was not going to pay us, we had debited $1,000. However, he did end up paying $200. So notice that what we're doing is we debited first. So to reverse, all we're doing is simply crediting for the balance that he did actually pay up. Okay, and that is the full transactions or the full journey of the transactions for a situation with an allowance that is actually then paid up.